Hello and welcome everyone to this weekly market recap for the week ending December 6th, 2024. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and it's certainly a pleasure to be here with all of you this weekend. It was a very interesting week in the market. We had the Dow Jones Industrial Average hit 45,000 for the first time. That was good news. We had the jobs report come out Friday morning, and the jobs looked pretty strong, close to what was expected. We did see a little bit of a tick up in the unemployment rate from 4.1 to 4.2%, but that was expected. Really, the only surprise was average hourly earnings, which was expected to rise 0.3%, actually rose 0.4%. So we did get a little bit of a surprise there that wasn't good. But overall, I thought the action was, or the report was pretty good. Prior month, the jobs, which had come in only at 12,000, they were revised up to 36,000. So that was a little bit better than what was previously reported. So all in all, I thought the report coming in this morning was pretty good on jobs. And the market just has continued to go push higher and higher and higher. But let's take a look at some of the numbers, and we'll look at some of the individual charts. So the Dow Jones Industrial Average this week, or today on Friday, dropped 123 points, but we did hit 45,000 earlier this week. So you can see we have given up a little bit of those gains. S&P 500 just continues to nudge a little bit higher and higher almost every day. Finished on Friday at 6,090 as another bullish session. The NASDAQ finished at 19,859, up 159 points, or 0.8%. That was where the strength was most of the week. The NASDAQ 100 down below, you can see, was actually up 0.9%, where you have more of a representation of the Mag 7 stocks. Those Mag 7 stocks were really hot this week, with a few of them breaking out above some key levels. And we'll talk about some of those companies a little bit later in the show. Small caps, mid caps, both up, but on a relative basis, lagging. They lagged throughout the week. But remember, that was the group, those were the two groups that had been leading. And we actually went up to key resistance on the IWM, which tracks the Russell 2000, at the end of a cup. So we kind of formed the right side of a cup. And what we saw this week was little downside action, which in my opinion was nothing more than perhaps a handle off of that cup. So we may see a return to strength in the small cap index at some point next week. Although I will say next week is not a great week historically for the stock market. December is a good month, but starting on Monday through the Friday of next week, we do tend to see historical weakness. So we'll see whether or not that kicks in and matters next week. Not a whole lot slowing this market down just yet. Maybe the most important thing on this that I'm showing you is that last line there, the volatility index dropping 5.7% on Friday, and that's now down below 13. What I can tell you is that historically, the best stock market action occurs when the VIX is below 13. We also have really good action in the market when the VIX is between 13 and 17. But below 13 is where we get our absolute best action. And that's what we've been seeing with that VIX coming down further and further. We're seeing more and more bullishness in the market. The secular bull market just keeps sailing along with really not a whole lot of warning signs along the way. We just keep pushing higher. Looking at the major indices, you can see over the last week, the NASDAQ 100 was up 3.3%. Whereas the S&P was up just 1%. And the other four major indices that we like to follow were in negative territory, especially transports, dropping 739 points this week, down more than 4%. That was definitely a drag on the Dow. So the Dow tried to make that breakout above 45,000, but the weakness in transports brought it back down. Small caps, you can see I mentioned mid cap, small caps, both came down a little bit this past week. After being somewhat overbought on its recent run to print the right side of the cup, especially on that IWM. Sector summary. So here are the various, the 11 sectors and how they performed last week. Notice consumer discretionary up 4.7%. Tesla and Amazon both had big weeks. Both are heavily weighted in that ETF. So there's your reason there. Technology up 3%. Communication services, that's home to the internet stocks. We had a big week on Meta platforms last week. So that one was up 2.57%. But that's where the strength pretty much ended. So that's kind of what we've seen over the course of the last couple of years, with the Mag 7 dragging those three aggressive groups higher, while the rest of the market lags pretty badly. Last week was very similar. I don't think it's the start of anything major. I do think that we're going to see small caps and some of these more defensive areas rally back later in the month of December, maybe even as early as next week. And I'll show you why again in just a little bit. But you can see the other 8 sectors were down, led by energy and utilities. One thing that's really surprising when I look at this is that normal December behavior has almost been flipped on its head based on what we've seen the first week. Normally, the 3 aggressive groups don't perform as well in the month of December, and we have areas like real estate and utilities that tend to lead in December. But look at the real estate and utilities group. There's reason to have hope going into next week. And again, I'll show you those charts in just a little while, but you need to be aware that at least the first week of December did not play out the way that we typically expect December to play out. 10-year Treasury yield, I just wanted to mention that for the first time in about 2 months, we went back down below the 50-day moving average on the TNX, taking out the most recent low after we had moved up and tested that declining 20-day EMA. So the way I'm looking at this, I think the 10-year Treasury yield could continue to drop a little bit here. And of course, we're expecting those short-term rates to be to move lower as well. That's what the Fed's been saying. That's what the Fed's been doing. And I think we're going to continue to see drops in the Fed funds rate. Let's just keep moving on. S&P 500. So one of the things that I look at to try to determine sustainability of a move to the upside is how consumer discretionary is performing relative to consumer staples. This chart, I think, illustrates this pretty well. The S&P from left to right over the last 20 years, moving up. And same thing for the XLY XLP ratio. That's what's in this middle panel. So we just continue to print higher lows, higher highs, although we haven't broken out above that 2021 high just yet. But we did make a pretty significant breakout above the high that we saw earlier in 2024, maybe even right at the tail end of 2023. So I like the action with discretionary leading staples, but a lot of really good behavior in consumer stocks in general. To me, that bodes well for the economy ahead. There's no reason for Wall Street, to be pouring into these consumer stocks unless Wall Street believes we're going to see a stronger economy down the road. And that's what I would expect with rates coming back down. This bottom panel is the one that I really like to look at, though, and that is the correlation. So in other words, how tightly do the S&P 500 and this XLY XLP ratio, how closely do they follow one another? When you get readings at 1, it means basically they're going hand in hand, up and down, that they ride together. When you go to -1, it means that they diverge. So when one goes up, one goes down. Well, you can see over the last 20 years, not once have we gone down to -1. In fact, getting down to -0.75 is rare. On the flip side, though, look at all the readings up near 1. I think it's pretty clear that there is a very tight positive correlation between the S&P 500 and between discretionary versus staples, that ratio. And right now, discretionary versus staples is absolutely soaring. And the S&P 500, we shouldn't be surprised, going right along with it to the upside. So I just wanted to make sure everyone was aware of that. All right, now let's take a look at the XLRE, because real estate historically throughout this secular bull market advance has been the best performing sector in the month of December. That's kind of unusual because December is a bullish month, but real estate tends to lead. And as I look at this, this is an hourly chart, so it's a 1 month hourly chart. But as we kept going lower in real estate here over the past handful of days, notice that the PPO, the hourly PPO, was doing the same thing. But after failing on the 20-day test and going back down to equal lows, look at the PPO. It's still going higher. So what that's telling me is on an hourly basis, we're actually we're showing slowing selling momentum on an hourly chart, which a lot of times will lead to a 50-period test. In this case, a 50-hour SMA test. Back up right now, it's near just below 44.40. So that could be a maybe 1.5% rally to get to that, but that may just be the start of a rally. That's just at that point we kind of see which way the XLRE goes from there. But I do like the fact that we have this positive divergence in play. As I look at the utilities, same thing. This is a chart going back. It's just the last month, 60-minute or hourly chart. And then in this case, we actually did go down and put in clearly a lower low, but the PPO is higher. So we've got a positive divergence here. So again, I think this could be a situation where we see the XLU move back up to test recent highs and maybe that declining 50-hour simple moving average. So a move back up to 81, maybe even a little bit above 81 next week wouldn't be a surprise. And again, that's just the start. We could continue going up through that 50-day moving average. And at that point, things would start to get a little bit more bullish for the XLU and possibly the XLRE as well. I did want to point out, let's go back and look at the XLY. I wanted to show you the absolute chart here. I mean, XLY is just flying to the upside. And this has been since the beginning of November. We started out, or we closed out October at 197 and change. We're now at 232. That's 35. That's probably about 18% rally in 5 weeks in discretionary stocks. Now you have to ask yourself a question. Why would discretionary stocks be going up this fast? Keep in mind the stock market looks ahead. So there's a lot of money that's pouring into discretionary, believing that many areas of discretionary, and remember, these are the companies that sell us the things we want. So they do better in a strong economic environment because that's when we buy the things we want. If it's a weak economic environment, we're going to avoid any unnecessary expenditures. I mean, you know, if things are great, I might go get my Starbucks coffee latte. But if things aren't so great and I want to start cutting some of my spending, things like that latte are things that could go out the window. And so that's the reason for following the ratio, the XLY, the XLP, because it gives us a flavor of what Wall Street believes is coming down the road. When the XLY, XLP ratio is going up, it means potentially a stronger economic environment. So we saw really good action there. XLK making a breakout above the double top. So we had a high in July. We went back, tested it in November, and then boom, broke out again there. Within this group, I'm still watching semiconductors, and semiconductors still have not broken above that June high of 21,000. So we still got a lot of work to do with the semiconductors, and the semiconductors, including NVIDIA, didn't participate in today's advance. So a lot of those Mag 7 stocks that went up, NVIDIA did not participate in that today. It did recently get back up above its moving averages, but you can see it's just sideways consolidating right now. We need to get semiconductors breaking out above that 21,000, and then we might see a stock like NVIDIA do something different than just the sideways consolidation that it's been doing. For those of you that are new to Earnings Beats, first of all, welcome. Welcome to the show. I think you'll find a lot of the things that we do at Earnings Beats, things we talk about, things I try to teach, will help in your trading. At least I certainly hope so. If you go to earningsbeats.com, I just want to point out that you can always sign up for our Earnings Beats Digest newsletter. All you need to do is go into our homepage, scroll down, you'll find this area. This is a completely free newsletter, no credit card required. You can unsubscribe at any time. These are charts that we put out twice a week, Mondays and Wednesdays. And along with the chart, usually a couple paragraphs explaining something about the chart. I like to talk about earnings, gaps, and how to trade those. You always will hear me talk about relative strength. I think that's incredibly important to make money in the stock market. You want to be riding leaders. You want to be invested in stocks that are leading the market. If you want to lead the market, if you want to beat the S&P 500, best way to do it is to be in stocks that are beating the S&P 500. That should just make good common sense. But that's something that we watch very closely. We talk about things like sentiment so that we can assess the market, overall market, whether or not we might go higher or lower. Those are all things really important to a trader. So anyhow, make sure you go over to earningsbeats.com and sign up for that. Now, we do have a slide on your screen now, which if you're on a mobile device, you can scan the QR code, and that'll take you to a landing page where you can sign up for the EB Digest. I want to mention we haven't really put out a whole lot of information about this just yet, but you're going to see a lot more about it over the next couple of days. We are going to be having an event next Saturday. It's free to everyone, open to the public. Members can register if you'd like. You don't have to. You're automatically included. We'll make sure you get room instructions to join us. But for those of you who are not Earnings Beats paying members at this point, you do need to register so that we can send you the room and so forth. But when you room instructions, but when we start to show more information on that, you'll see it over to Earnings Beats. I would highly recommend that you sign up for the EB Digest. We'll be reaching out all week long to Earnings Beats Digest folks to join us to register for next Saturday's event. And essentially what we're looking at is market rotation into 2025. Joyous DeKempenaar, who is the senior technical analyst or one of the senior technical analysts at Stock Charts, and he is the creator of the relative rotation graph charts, RRG charts. He'll be joining me. So we're going to be debating back and forth about what's working in the market now, what we see going into 2025. I think it'll be an eye-opening event again. We are making it open to the public. Anyone can go, but you do need to register. In the description to this video, you will find a link that will take you to the registration page for the event. So make sure you go into the description, click on the link, and that'll give you an opportunity to sign up for the event. Also give you some information about the event, things we'll be talking about. And I think, again, I think it'll be a great experience for everyone. It'll be an educational event. And so I hope you can join us. One thing that we've been doing, I mean, we are just honestly knocking the cover off the ball right now in terms of our portfolios. Our model portfolio now since November 19th, 2018 is up 281%. The S&P 500 over the same period is up 126%. So we're up like 120% more than the S&P 500. We more than doubled the S&P 500, and this is over a 6-year period. This isn't doubling the S&P for a month or for a week. This is over 6 years. I think we're doing something right. Our aggressive portfolio has been absolutely on fire. I think over the course of the last 6 weeks or so, our aggressive portfolio has been up about 37%, and the S&P 500 has been up about 3 or 4%. These small cap stocks, when they come back down and they hit support, we had a couple of those that we were able to add to our portfolios in this most recent quarter. Some of them just broke out and have just never looked back. But look at this quarter performance, and we're only talking about from November 19th to today, which is December 6th, 17 calendar days, which is roughly 2 weeks of trading. And our aggressive portfolio already in 2 weeks is up 11.7%. S&P 500 is up 2.9%. So I've been talking about small caps, the opportunities that these small caps present. even when small caps don't seem to be performing well, like this past week, the leaders among small caps and mid caps have been absolutely flying. So all I can say is at some point, you're going to want to come in and check us out at Earnings Beats. I think will make a big difference in how you approach the market and ultimately, hopefully, help you get to your financial goals. All right, just a couple more things before we wrap up. I wanted to show you a couple of these Mag 7 charts because they're absolutely crazy. Tesla, this is a weekly chart, but look at this week. We just went up 12.8%. We're now up to 389.22. The highest level ever on Tesla is 414.50. That's the highest trade ever. And we are now only about $25 away from that after this huge week. So Tesla's looking good. I'm going to go ahead and move back to a daily chart because I wanted to show you Tesla, which you can see has just been absolutely on fire. This is helping lead the XLY, consumer discretionary, to the upside. Also helping to lead to the upside, Amazon. So look at Amazon breaking out, also very strong November. And if I pull up the weekly chart here, it is broken out to an all-time high. I think this move is just getting started on Amazon. So this is one of my favorite Mag 7 stocks. I've been talking about it recently. I thought the pullback below 200 was a great opportunity to jump into Amazon. And you can see it was up 9.2% last week. Another Mag 7 stock really strong last week was Meta. Look at this, another breakout on Meta, jumping 8.6% last week and to another all-time high. And then beyond the Mag 7, I don't know, maybe we need to move it to the Elite 8, kind of like college basketball. But check out Netflix. Netflix, after breaking out above the high we saw back in 2021, this thing has just been ripping to the upside. It's gone on the breakout around $700. It's now $934. And the breakout just occurred in October. Maybe the best thing of all is that Netflix best month of the year is January. We haven't even seen January yet. So another one that's been doing extremely well. Also, before we wrap up, I want to show you some of these small cap and mid cap names. A couple of these might be in larger cap, but these are some of the stocks that we've been talking about with our members that have pulled back to great entry points. And then at the end, I've got one that just hit a great entry point in today's action. So it's going to be really interesting to see how it performs next week. But let's start off with Ambarella, AMBA. This is a semiconductor stock. Look at the gap up with its earnings. It came all the way back down and filled its gap. And look today, back up 3.4% just today. Next up is Trade Desk. So Trade Desk gapped down with its earnings, had great earnings, but gapped down. It was a sell on news. So buy on rumor, sell on news. We went back up, tested the high. And when it came back down right here on November 19th, in a daily market report I sent out to members, I said this is a great entry spot for Trade Desk because if it breaks down below 115 and that 50-day moving average, you don't lose much. But if the uptrend remains intact, you can have a quick reversal to the upside, which is exactly what we saw here. Then we've got Polo Ralph Lauren, which had gapped up, came back down again. November 19th, I featured it in our daily market report to members. And look at this, right back up, putting in a cup. Now we've got a little handle going out to the side. I think ultimately we're going to get a breakout. If we could pull back maybe to that 20-day moving average, I think that would be a really nice entry on any subsequent pullback from here. Doximity, Dox. I can tell you this is one of our portfolio stocks that we got into November 19th, right around the upper 40s. And now look at what's going on here. Nice rally off that 20-day moving average. And now we're back up 55.5. Likely, I think, moving back up to test the recent high around $61, $62. Next up, CRDO. Now, CRDO just recently reported, look at that volume that came in and supported this move to the upside. When stocks gap up like this, I like to look at the top of gap support as key support. And you can see 2 days later, after hitting 75, CRDO actually came back down and approached that 65 level, hitting 66. And now 24 hours later, the next day, we're back up near 75. So CRDO hitting or getting close to support and bouncing. Again, these are the things that we like to look at. WWD, Woodward Governor. Look at the gap up with earnings. What happens? We come back down to gap support. I think we're still kind of consolidating here. Another test of this low, in my opinion, brings us right back to this 20-day moving average, which I think would be a great reward risk entry. Sono. So look at a big gap up on Sono. Stock was up almost to $16 with its earnings. Goes all the way back down to where prior price support was. Look at the reversing candle. That's a piercing candle right at the 50-day, right at price support. And now look at it moving back up toward that 15.5 level. A breakout above 15.5, and this is a stock that could really, really start to run. I like Sonos. And then the last one I have for you is Marvell, MRVL. Here was the gap up. Look at the volume that came in, almost 60 million shares, highest by far for the entire year. We gapped up, we kept moving up. Now we're pulling back, and we're back near the open of where we opened on Wednesday after earnings had come out. Marvell had just blowout results. Revenues and earnings blew away estimates. They raised their guidance. We saw the huge gap up. Stock got up to about 120, and now it's back down to 113. This is what I look for. I like to see these pullbacks to give me opportunities to get in cheaper. All right, that's it for me. I really appreciate everybody tuning in. Do me a favor. If you really like our show, you can help us on YouTube. Hit that like button. Subscribe to our channel. That'll help us in the algorithms as we try to build our presence and community here on YouTube. So again, thanks to everybody for all your support. Go over, follow the link in our description, and come over and sign up for the event for next Saturday. Julius and I are going to have a great time. If you follow Julius over at Stock Charts, he's the master with the RRG. He's going to show you some updates that they've made over at Stock Charts on that. He and I are going to talk a little bit back and forth about different areas of the market, what we're seeing in terms of rotation, and what that could mean for the balance of December and into 2025. So I think it'll be a timely event, and in an uncertain market like this, we all need all the help we can get. So we're going to try and help out where we can. Anyhow, have a great weekend, everybody. Again, hit that like button and subscribe. We'd certainly appreciate it. Happy trading.